Listen to this, because what most retirees don't realize is that the very institution you trust to protect your life savings might actually be building a federal case against you right now. Millions of Americans are unknowingly making a massive mistake with their bank deposits, a mistake that could literally cost them thousands of dollars or worse, have their accounts completely frozen with zero warning. Welcome to this explainer. Today, we're diving deep into a financial expose specifically created for seniors over 60, pension recipients, and honestly, anyone focused on retirement planning. Here's the harsh reality. If you keep a large amount of cash savings sitting in a traditional checking or savings account, you're currently losing money in three distinct ways. Two of those ways are silently eating away at your retirement savings. But the third? Well, the third is a hidden algorithmic trap that your local bank will never, ever warn you about.
The number you're about to hear could affect your retirement savings permanently, $25,000. If you have more than this exact amount sitting idle in any single checking or savings account as we approach 2026, you are crossing a very dangerous threshold. Now, you might be thinking, isn't a big balance a good thing? Well, your bank definitely thinks so. They profit immensely when your money just sits there, so they have absolutely zero incentive to tell you what I'm about to show you. The truth is, any dollar you keep over this $25,000 mark exposes your hard-earned retirement income to severe mathematical and legal vulnerabilities. Let's look at exactly what happens to those excess funds when you leave them exposed.
But this is where many retirees get caught completely off guard. We all know that inflation quietly eats away at our cash savings over time. But what happens next surprises most Americans. Beyond just the mathematical loss of keeping too much money in one place, you make yourself a prime target to be flagged by automated banking algorithms. You could literally have your funds frozen without notice and your personal information reported to a secret federal database shared by the IRS and Homeland Security. And honestly, the most terrifying part of these strict bank reporting rules, you will never be told you're under investigation. You're just in the system.
To really understand how this works in the real world, let me tell you this story of Robert. Robert is a 68-year-old retired union electrician. He worked for the exact same company for 34 years, collected his pension, and had a savings account at his local bank branch for 19 years. Robert was a careful guy. He had saved up about $140,000. So last winter, he decided to help his daughter buy her first house. The down payment she needed was $22,000. On a perfectly normal Tuesday, Robert walked into his bank to get a cashier's check. But instead of a check, he got an interrogation. The teller stared at the screen, asked him to sit in the lobby, and then a branch manager pulled him into a private back office. They aggressively demanded to know why he needed his own money and exactly who he was giving it to. Robert, a perfectly competent grown man, was subjected to a sudden 48-hour compliance review. He literally had to drive to a gas station payphone to tell his daughter her house closing was delayed. And the kicker? 3 weeks later, a secret federal report was filed against him anyway.
Okay, so let's break down exactly what happened here and look at the bank account rules that trapped Robert. Proper money management requires understanding a piece of the Bank Secrecy Act that most people have only vaguely heard of, the Currency Transaction Report, or CTR. Anytime you deposit, withdraw, or transfer more than $10,000 in cash in a single day, your bank is legally required to file a CTR directly with the Financial Crimes Enforcement Network, also known as FinCEN. This isn't a casual memo. This report includes your social security number, your home address, and the exact minute of your transaction. It goes straight into a massive database shared with the IRS Criminal Investigation Division and roughly 400 other government agencies. And once you're in that database, you stay there for 5 years, and every future move you make is cross-referenced.
But here is the part banks rarely explain, and it's the rule that actively threatens your financial security on a daily basis. Most people think, hey, if I just stay under that $10,000 limit, I'm completely safe, right? They are not. Enter the Suspicious Activity Report, or SAR. This is a secret compliance report triggered entirely by bank algorithm software. And get this, it has absolutely no minimum dollar threshold. It could be for $100. It could be for $2,000. It doesn't matter. The decision is made by internal software that simply flags your innocent transaction as an unusual pattern. The bank then has 30 days to file this SAR into that exact same federal database, and you have absolutely no legal right to know it even happened.
And here is the truly shocking part of this whole system. If a bank teller or a manager actually warns a customer that a suspicious activity report is being filed on them, that employee has just committed a federal felony. It's called tipping off, and it carries up to 5 years in federal prison. So your bank legally cannot tell you they're watching you. But more importantly, you have to understand the bank's incentives here. A bank faces zero penalty for filing a false report on an innocent senior. None. However, if they fail to file one and government regulators find out, that bank can be fined millions of dollars. So their entire incentive structure is completely skewed. Freeze the account first, report the customer first, and maybe ask questions later.
So what actually sets off these digital alarms? Let's look at how everyday behaviors can trip these secret algorithms. There are specific triggers that the software looks for, and most retirees hit at least 3 of these without even realizing it. Trigger 1, breaking your historical pattern. If a grandmother who usually withdraws $300 a month suddenly takes out $2,000 to buy plane tickets to see her grandkids, the system instantly flags the deviation. Trigger 2 is called structuring. This is making multiple smaller deposits that happen to add up to $10,000 over a 90-day window. And trigger 3, first-time wire transfers. The algorithm literally cannot tell the difference between you wiring money to a local kitchen contractor for a remodel and a scammer draining your account. It treats both as a high-risk criminal event.
And the next mistake can cost retirees everything they've worked for. Remember that second trigger I just mentioned? Structuring? That is actually a federal felony, even if the money is 100% legal and yours. Innocent Americans navigating senior finance have been absolutely destroyed by this through something called civil asset forfeiture. Take the true story of Carol Hinders. She ran a small Mexican restaurant in Iowa for 38 years. Because her business insurance policy capped the amount of cash she could keep on site overnight, she frequently made deposits to her bank in amounts under $10,000. The IRS swooped in and seized her entire operating capital, $33,000, without ever filing a single criminal charge against her. It took her 2 agonizing years of pro bono litigation just to get her own money back. As the quote notes, "You literally have to prove you didn't do anything wrong, and while you are proving it, your money is just gone."
Let's look at the final 4 algorithmic triggers that routinely snare innocent people. First, round numbers. If you deposit exactly $9,000, it triggers alerts because the computer assumes you're trying to dodge the $10,000 reporting rule. Next is an income and activity mismatch, which is a massive red flag for seniors. Say you are a retiree drawing regular Social Security, and suddenly you deposit $12,000 because you cashed out an old life insurance policy. The algorithm flags you because that sudden influx doesn't match your known predictable retirement income. Then we have third-party cash deposits, like if your adult son deposits cash into your account to pay you back for something. That is heavily scrutinized. Finally, high-risk geographic associations. If you wire money to a perfectly legal, legitimate business that just happens to be located in a zip code the software has blacklisted for fraud, congratulations, you're now under investigation by association.
Now, let's shift gears and look at the second danger, the harsh mathematical reality of keeping too much cash at the bank. This is a fundamental lesson in personal finance. Right now, the average national interest rate on a checking account is practically 0. We're talking around 0.06%. Meanwhile, everyday inflation is eating away at your purchasing power at roughly 3%. Let's put that in perspective. If you leave $50,000 sitting in checking, you are guaranteed to lose $1,500 of real purchasing power in just 1 year. Yet your bank turns right around and lends your exact same money out to borrowers for mortgages and car loans at 7 to 12%. They keep that massive profit spread, and you keep the inflation loss. Let's be real, you aren't the customer in this scenario, you are just the supplier of cheap capital.
And that brings us to the third hidden danger, which exposes another massive vulnerability: FDIC insurance limits. The Federal Deposit Insurance Corporation only protects up to $250,000 per depositor per insured bank. Now, we all saw those massive American bank failures recently with Silicon Valley Bank and First Republic. And yes, while those specific depositors were fully bailed out as a political decision, there is absolutely no law guaranteeing that will happen next time. If your local bank locks its doors on a Friday afternoon and doesn't reopen on Monday, any single dollar you hold over that $250,000 line in one account is entirely unprotected. You could literally lose it forever.
So, the absolutely crucial point here is understanding exactly when you are most vulnerable to these retirement mistakes. There are 3 highly emotional, critical retirement danger moments where sudden wealth hits your account. First are required minimum distributions, or RMDs, which kick in at age 73. These can dump $40,000 or more into your checking account all at once, instantly triggering an algorithm. Second is receiving your hard-earned pension as a lump sum wire transfer. And third, and honestly the most heartbreaking, are survivor benefit deposits or inheritances when a spouse passes away. Dealing with a cold compliance officer interrogation while you are actively grieving the loss of a loved one is a nightmare that no widow or widower should ever have to endure.
So what does all this mean? What is the actual solution?
How do you practice proper wealth protection and shield your retiree financial planning from these algorithms, from inflation, and from potential bank failures? Well, you take a page right out of the playbook of professional financial planners. The rule is actually quite simple. You keep 3 to 6 months of essential living expenses in your local checking account, and you strategically move the rest into what we call safe harbor accounts. These are specific, highly secure alternatives designed to generate yield, protect your wealth, and completely remove your money from your local branch's algorithmic radar. Let's dive into exactly what these are.
The first two safe harbors are basically the foundation for solid retirement strategies. High-yield savings accounts, or HYSAs, at major online banks like Ally or Capital One are currently offering around 4% interest. They are fully FDIC insured, totally liquid, so you can get your money anytime, and they literally take about 10 minutes to open from your couch. Compare that incredible flexibility against United States Treasury bills. T-bills are short-term loans you make directly to the U.S. government. They currently pay around 4.5%, and here's the best part. They are completely exempt from state income taxes. If you live in a high-tax state like California or New York, building a ladder of T-bills where a portion of your money matures and becomes available every few weeks is incredibly tax-efficient and essentially the safest place on earth for your cash.
Moving right along to our next two options, Series I savings bonds are incredibly unique. They are the only investment in the United States guaranteed by federal law to keep pace with inflation. The interest rate automatically adjusts every 6 months based on the official inflation rate, cleanly protecting your purchasing power no matter what the economy does. On the other hand, we have brokered CDs, which you purchase through major brokerages like Fidelity or Vanguard. These are a real game changer because they allow you to access high certificate of deposit rates from hundreds of different banks simultaneously. For wealthier retirees, you can literally spread $1 million in cash across 4 or 5 different banks in 15 minutes, ensuring every single penny stays safely under that $250,000 FDIC limit.
And that brings us to the fifth safe harbor, the money market mutual fund, which is housed inside a regular brokerage account. Funds like the Vanguard Federal Money Market Fund hold short-term U.S. Treasury obligations. Now, while these aren't technically FDIC insured, they are backed by the absolute safest assets on Earth, United States government debt. These funds are an absolute staple of smart retirement investing. They offer complete liquidity, usually paying between 4 and 5% right now, with absolutely no minimum holding periods. Moving large sums of money, like a massive pension lump sum, directly into a brokerage account completely bypasses the retail banking compliance algorithms we talked about earlier.
So let's bring it all together and look at exactly how to segment your funds. For a retiree drawing Social Security or a pension, the ultimate cash allocation strategy looks exactly like this. First, keep 1 to 2 months of living expenses in your normal local checking account. That is just your operating capital for groceries and bills. Next, put 3 to 4 months of expenses in an online high-yield savings account. Then keep 6 to 12 months in that laddered Treasury bill setup we talked about. Any remaining emergency funds should sit comfortably in brokered CDs or money market funds. Doing this structurally insulates your retirement investing from local brand scrutiny and keeps you completely off the radar.
And you guys, the staggering mathematical impact of making this simple structural shift cannot be overstated. If a typical retiree takes $150,000 out of a stagnant, zero-interest local checking account and utilizes this exact safe harbor strategy, they generate an extra $4,000 to $6,000 a year in passive interest. Over a standard 25-year retirement, that single, simple move compounds into an additional $120,000 to $180,000 of income. Think about that. Zero additional risk, zero loss of access to your money, and zero exposure to suspicious activity algorithm triggers. It's a total no-brainer.
But what if you're sitting there right now, suspecting you've already been flagged by your bank? Maybe you've noticed wire transfers taking a few days longer than usual, or branch managers stepping in to approve completely routine withdrawals. Here is your practical action plan. Rule number 1, do not, under any circumstances, ask the teller if a secret report was filed. Legally, remember, they cannot tell you, and asking just makes you look infinitely more suspicious. Instead, you need to stay completely calm. Begin migrating your excess funds slowly, calmly, and in normal, natural amounts over several weeks into the safe harbor accounts we just discussed. By the time their software does its next algorithmic review, your balance will be far too small to trigger any further alerts.
Let's bring this narrative full circle back to Robert, our retired electrician. After his absolute nightmare interrogation over helping his daughter, Robert decided to take control.
He kept $10,000 in his local checking account, moved $20,000 into an online high-yield savings account, and laddered the rest of his savings in T-bills. A few months later, when he needed to transfer some more money to his daughter for renovations, it cleared in a single afternoon. No backroom manager interviews, no driving the gas station payphones, no federal reports. As Robert himself said, the biggest surprise was how simple it was. Once the money was out of the watched account, it literally stopped being watched. Reclaiming his financial independence was truly that simple.
So what's the biggest takeaway you need to remember today? It's the $25,000 rule. Any dollar you keep above that line sitting idle in a normal bank account is just drawing unwanted algorithmic attention, it's losing purchasing power to inflation, and it's exposing you to federal risks you simply do not need to carry in your golden years. The IRS is not going to warn you, and your bank certainly won't tell you. So the question is, will you leave your life savings exposed, or will you take control this month? Protect your retirement strategies by taking action today. If this explainer opens your eyes and helped you out, please share this with a loved one over 60 who needs to hear it. And hit that subscribe button to keep your financial future secure. Thanks for being here, and I'll see you in the next one.